As market trader, Sarah Asimwe arranges the fruits and vegetables for display at her stall in a small Ugandan town. She considers how easy it has become for her to source produce with mobile money. She sends money to the villages around, and the farmers send her matoke, oranges and mangoes on the bus. Just a few years ago, the majority of the population in Sub-Saharan Africa, including small business owner Sarah Asimwe, would have very little interaction with the formal financial system. But thanks to mobile money services and agent banking, this is beginning to change. In 2011, when the Partnership for Financial Inclusion was conceived, mobile money accounts were few, but there was growing recognition of the potentially revolutionary power of digital finance. The partnership embarked on two things: to work with clients to scale digital financial services in Africa, and to run a parallel knowledge program to better understand how this can best be done. To help build industry knowledge, the program decided to tackle three main questions. How do digital financial services impact users? Is there a business case for providers? What are the drivers and barriers to the expansion of digital finance? As of 30 June 2018, close to 40 studies over 6 years and important operational learnings from 14 projects in 9 markets resulted in 13.6 million new registered DFS users, 86,000 new agents, 1.3 million new savings accounts, and $646 million in monthly transactions. This far exceeds the original targets of impact. Here's what we have learned. The headline numbers show that digital financial services has had an enormous impact to boost financial inclusion in Sub-Saharan Africa. The percentage of adults, those over 15 years of age, who use mobile money accounts increased from very few in 2011 to 20.9% in 2017. This pushed the overall financial inclusion rate from 23.1% in 2011 to 42.6% in 2017. Our research studies have focused on specific countries and groups of DFS users, bringing richer detail to these headline figures. We have found evidence that people feel excluded from banks, but not from mobile money. 60% of smallholder farmers in Côte d'Ivoire said they didn't have enough income to justify a formal bank account, while just 17% said the same about a mobile money account. Small-scale entrepreneurs appear to benefit from mobile money too. In a Uganda study, we found that 63% of the most active DFS users were entrepreneurs, and that 42% of overall users use DFS for business transactions. DFS can help improve livelihoods. One of our studies found that smallholder farmers who save are better able to feed their families during the lean months before the next harvest. 31% of smallholder farmers who do not save said they had difficulty in feeding their families, while the same was only true for 18% of farmers who save. DFS can meet a pent-up demand for savings, even without interest. Some 52% of smallholder farmers in Côte d'Ivoire said they use mobile money to store money. Turning to question 2, the business case. It would not be possible to leverage DFS to extend financial inclusion if providers didn't find a compelling business case to do so. There we have some good news. The first being that transactions at agents are about 25% less costly to provide than branch transactions. We have also found that DFS results not only in broader, but also deeper financial inclusion. Customers who open accounts at agents rather than bank branches become more frequent and enthusiastic bank customers. Agent banking customers make 2.8 times more deposits and 3.2 more withdrawals during the 12 months after opening an account than branch customers. Their bank balances of the 12 and 24 months were on average 18% and 34% higher respectively. We have found that the cross-selling of DFS products to increase revenue per user is the key to success, as scaling alone does not lead to break even. The marginal expenses of transactions represent on average 70% of the total, and there are very little diminishing costs. The sustainable performance of greenfield microfinance institutions shows that historically underserved businesses and households are most definitely bankable and even profitable market segments. Coming to our final question, what are the drivers and barriers to the expansion of digital finance? The first driver, quite simply, is speed. Because of geographic proximity, waiting times at agents are reduced and transaction costs are lower, which result in an increased volume and frequency of transactions. In one of our studies, the total time to open an account at an agent, including waiting time and face-to-face meeting time, was on average 9.8 minutes shorter than to open an account at a branch, which took about an hour. Agents are important in driving uptake and activity, and it turns out gender may play a role. We found that agents are more successful when they are female, have a service-related business, and are located in low-income, high-density areas. Women agents registered a higher total number and value of transactions per month than men, and on average, the male agent did not perform as well as the female agent. Another learning is that high GSM phone usage points to higher DFS usage and activity rates. Our study in Ghana shows that the most likely potential active mobile money users are voice customers that make at least 151 telephone calls per month, have at least 240 minutes of talk time, and spend the equivalent of about $6 per month on voice services. A geospatial analysis showed that 60% of them live within the urban boundaries of the capital city. We also found that people who have larger social networks are more likely to be active users of DFS. Having 50 additional voice contacts raises the odds of being a key user by 52%, and an additional 2.24 average calls per contact raises the odds by 45%. We did find a disparity between male and female DFS users though. Interestingly, low active male users, 49.6%, have the same level of DFS usage as high active 50.3% female users. Among the barriers to DFS expansion are a lack of perceived security, inefficient network coverage in rural areas, high transaction charges, and inconvenient opening hours, for example. We found that some users in Ghana would not make payments through agents because of inconvenient agent locations, lack of trust, unreliability, a fear of excessive charges, and a belief that it is time-consuming. In Côte d'Ivoire, we found that the top 3 challenges are poor geographic coverage, poor customer services, and failing transactions. Financial literacy was found not to be a driver of inactivity in one survey. Inactive DFS customers are just as likely to be financially literate as illiterate. But the picture is unclear. Answering questions to assess knowledge on mobile money, active mobile money users in Uganda answered more questions correctly than non-users, while in Zambia, active users answered the fewest questions correctly. A fundamental barrier to mobile money uptake is self-exclusion. In Côte d'Ivoire, 30% of small-scale entrepreneurs think that mobile money is not for them. More than 50% of them think that banking services are for rich people, and 38% found banks intimidating. A full 1/3 of respondents do not believe mobile money is for everyone. For some, banks, mobile phone shops, and even agent booths are seen to be places where they don't belong. They feel like outsiders and even fear that they may be refused service. What about the future? The latest Findex numbers show a continued increase in DFS usage on the continent and an expansion of financial inclusion, although at a slower rate than from 2011 to 2014. Financial inclusion growth is broader rather than deeper. Expansion is generally driven by payments, while other services have not become as broadly available yet. Much remains to be done in order to reach universal financial access in Sub-Saharan Africa, and especially to ensure that small business owners like Sarah Asimwe become fully included in the formal economy and offered the financial tools to grow and develop their businesses to full potential.